Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Friday afternoon, we have Mark Marex, senior specialist with index research and development at Nasdaq Investment Intelligence, to discuss earnings and valuations for the Nasdaq-100. Mark, it's great to see you. Welcome back to Trade Talks.
Thanks, Jill. Great to be here as always.
All right, you got it. Let's start with a quick update on performance that you're seeing year to date.
Yeah, so I mean, last time, if you remember, we dug into some of those recent earnings reports from the likes of Apple, Microsoft, and Google. You can see those are few of the names that have relatively outperformed year to date, although everything is negative year to date on this chart. Facebook is the big outlier, down 38% year to date, mostly on the back of a pretty disappointing earnings report. But, you know, what we were getting into in that discussion a little bit was some of the kind of fundamental resiliency and strength of a lot of those other companies that had reported at that point in time, and trying to kind of theorize, well, is this pullback in the Nasdaq-100 fully warranted given what we know that's happening with inflation, with interest rates and things of that nature that are putting pressure on a lot of these higher valued, higher growth companies. We have some new data today that I want to discuss that kind of, I think, supports that notion further, some of those structural tailwinds that Nasdaq-100 has versus the rest of the market.
Right. So let's go to your next slide here, Mark, and talk about some of these fundamentals that you're looking into, specifically around debt ratios.
Yeah, so I mean, there's a lot of numbers on this chart. What I'm trying to communicate here is a pretty simple idea, which is that, you know, if inflation is as big of a concern as some people think it is, and it's not going to be transitory and it's not going to reverse when supply chains normalize, and that then is going to really push the Fed to raise rates quite a bit higher than anyone had been expecting up until recently. I mean, that's going to have an impact on valuations, right, in terms of discounting future growth at a higher rate, but it also has an impact, a much more kind of tangible real world impact in terms of debt service costs, right? The more debt you have as a company to finance your business model, the higher interest rate you're going to end up paying if market rates move up and you've got to refinance at higher rates and you have a more leveraged business model, et cetera, et cetera. So if you look at the Nasdaq-100 as an index and you look at the broadest possible measure, right? What's the total debt of the index as a percentage of market cap? As of recent numbers, the median is about 5.1%. The average is 13.5% per company. The weighted average is in the middle there, 9.1%. And then the aggregate kind of total, right? Total debt of the index over total market cap is 8%. So those are pretty low numbers. When you compare that to the S&P 500, all those numbers are 20% or higher. And when you strip out Nasdaq-100 companies from the S&P, that's the SPX NDX section, you're getting up into the mid to upper 30s in some of these ratios, which just tells you, again, that very fundamental difference in how the business models are aligned for a lot of these higher growth, higher valuation tech companies in the Nasdaq-100, much less reliant on debt to support kind of everyday costs of running that company. On the right-hand side of this chart, you can see a couple other different angles of looking at this. Not as clean as that ratio. I've got debt to last 12 months EBITDA, and I've also got interest expenses as a percent of EBIT, or what you would consider operating income. You got to exclude financials from these, which are a big part of the S&P, not a part of the Nasdaq-100 at all, because interest expense is an operating expense for financials, so you can't strip it out the same way. But even once you exclude the financials, there are very big differences here, right? It's 56% lower debt to EBITDA ratio for the median Nasdaq-100 company. The average ratio is 42% lower than the S&P 500. You look all the way on the right, that final one, interest expense to EBIT ratio is 67% lower. That's for the median. And the average, same exact thing, 67% lower for the Nasdaq-100 versus the S&P 500 ex financials. So really, really big differences here that I think a lot of people forget when they think about this inflation argument. It's going to hurt growth valuations. That means the Nasdaq-100 is going to get hurt some more. But what happens when actually the Fed ends up having to raise rates a lot and raise the cost of debt? It's going to hurt some companies more than others, it's going to hurt the more indebted ones more than
Right.
others.
And that's a great point that you make. And I think your last side is especially interesting to me when we take a look at employee efficiency and we start talking about another area that's really hot with inflation right now. And of course, that's rising wages. And as we all know, Mark, that's not transitory. You don't raise wages, then take it away. So this is something that companies are going to have to grapple with.
Yeah, absolutely. And this chart's actually quite a bit easier to read. There's fewer numbers on here and it's a simpler story, right? If you look at average revenue per employee, it's actually pretty similar, Nasdaq-100 versus S&P 500. But take a look on the right when you look at actual net income, profit per employee, it's 37% higher for the Nasdaq-100 companies in aggregate versus the S&P 500. When you strip out NDX, that difference grows, right, as you would expect. So the simple theory here is that, yeah, if you're raising wages 10% across the board, guess what? You have much less of a cushion if you're in the S&P 500, excluding the Nasdaq 100 companies, to raise those wages and not take as big of a hit to your bottom line. There's just more cushion to play with in the Nasdaq 100, not to mention things like ease of doing remote work, ease of spreading people around into lower cost areas. Tech companies have a built-in advantage for that. We can't quantify that, but anecdotally, we know that to be true. So again, from the debt angle or from the wage inflation angle, I think there's two solid arguments to be made here that there are structural advantages for the Nasdaq 100 to hold up better if inflation continues hot and we get those interest rates moving up into higher than average territory.
All right, Mark. Great insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.